As the trading day unfolds, Tilray Brands Inc., trading under the ticker TLRY, is currently priced at $1.15 per share, reflecting a significant intraday drop of 5.89%. This sharp downturn pushes the stock closer to its session low of $1.10 than its opening price of $1.19, a move that many will dismiss as just another volatile day in the cannabis sector. But to label this as simple expected volatility is to potentially miss the far more complex and crucial narrative unfolding beneath the surface. The expectation for a stock like Tilray is a binary bet on legislative headlines, a lottery ticket waiting for Washington to act. The reality, however, is a multifaceted corporate battle being waged on fronts far beyond the U.S. political arena, and today's price action is a direct reflection of the market's growing impatience and its failure to price in the true nature of this evolving company. Many investors, whether they are using sophisticated platforms like interactive brokers or simplified mobile experiences like the Robinhood app, view the entire cannabis industry through a singular lens. But the reality for Tilray Brands is far more nuanced. The common belief, the story told in countless online forums and investor chats, is that Tilray's fate is inextricably linked to the slow, grinding gears of U.S. federal cannabis legalization. This narrative suggests that shareholders are simply biding their time, weathering storms like today's nearly 6% decline, while waiting for the monumental catalyst of DEA rescheduling or the passage of the Safe Banking Act. This expectation frames the stock as a passive investment, a waiting game where the primary variable is political will. But this perspective is dangerously incomplete. It fails to account for the aggressive strategic transformation Tilray has been undergoing, a pivot from a pure-play cannabis producer into a diversified consumer packaged goods powerhouse. The market continues to judge the company on a promise for tomorrow, while largely ignoring the tangible business it is building today. The disconnect between this expectation of a simple cannabis play and the reality of a complex CPG strategy is the central tension that defines this stock's turbulent behavior. Investors utilizing tools like Fidelity Wealth Management or Schwab Intelligent Portfolios for long-term planning must look beyond the single-issue narrative to understand the true risk and reward profile here. Let's dissect the recent market activity to uncover the deeper reality. Today's sell-off is not happening in a vacuum. It comes on the heels of a brutal week that has seen the Tilray stock shed over 19% of its value. Yet zoom out just a bit further, and the 3-month chart tells a story of an explosive 190% gain. This isn't simple volatility, it's a violent tug-of-war between competing market forces. On one side, you have momentum traders and short-term speculators, many using accessible platforms like SoFi Invest, who jump in and out based on fleeting rumors of legislative progress, creating those sharp rallies. On the other, you have long-term holders and institutional funds becoming increasingly wary of the perpetual delays leading to periods of sustained selling pressure like we're witnessing now. The trading volume today, already exceeding 34 million shares, is significant and suggests that this isn't just retail jitters, there is serious capital moving. This is where the self-investing individual using Fidelity ETFs or managing their own individual brokerage account must ask a critical question. Is this a fundamental reassessment of the company's value, or is it algorithmic trading responding to sector-wide negativity? The reality is likely a combination of both, exacerbated by a broader market sentiment that has grown cautious, punishing companies that lack consistent profitability, a category in which Tilray firmly resides, with a trailing 12-month earnings per share deep in negative territory. The core of the matter, and what the market seems to consistently misinterpret, is Tilray's strategic diversification into the beverage alcohol industry. This isn't a side project, it's a foundational pillar of the company's future. With the acquisition of brands like Sweetwater Brewing Company, Montauk Brewing Company, and others, Tilray has become a top 5 craft brewer in the United States. This segment provides the company with something the cannabis market cannot: stable, predictable revenue streams, established distribution networks, and a physical infrastructure that spans the entire country. This U.S. footprint is not just about selling beer, it's a Trojan horse. When federal cannabis legalization does occur, Tilray won't be starting from scratch. It will have a ready-made distribution and marketing apparatus to immediately deploy cannabis-infused beverages and other products, giving it a colossal first-mover advantage. The market, however, remains fixated on the Canadian cannabis market struggles with oversupply and pricing pressure, and the sluggish progress of German medical cannabis sales, while viewing the beverage division as an unrelated, dilutive venture. This is a fundamental misunderstanding of the long-term strategy. The expectation is that Tilray is waiting for a key to unlock the U.S. market. The reality is that it's already building the house, just waiting for the final permit to be signed. This is a crucial distinction for anyone considering an online investment in the company. Tilray Brands operates a global business with a clear, albeit challenging model. In Canada, it remains one of the largest licensed producers, battling for market share in a highly competitive and regulated environment. Internationally, it has a strong presence in the European medical cannabis market, particularly in Germany, which represents a significant long-term growth opportunity as regulations there continue to evolve. But the most critical component is its U.S. strategy, which currently revolves around its CPG portfolio of craft beer, spirits, and wellness products. This is designed to build brand recognition and secure distribution channels in anticipation of federal permissibility. The company's financial reports, which I scrutinize by analysts on every major investment site, reveal a company in a state of costly transition. While revenues have grown, consistently hitting hundreds of millions of dollars annually, profitability remains elusive. This persistent cash burn is a major point of concern for investors and a key reason why the stock is so vulnerable to sharp sell-offs. The management team has repeatedly emphasized a path to positive adjusted EBITDA and eventually positive free cash flow, but the market's patience is wearing thin. The performance of its Apple stock or Nvidia stock holdings would present a stark, more stable picture than the roller coaster that is Tilray stock. Looking to the future, the outlook is a complex tapestry of immense opportunity and significant risk. The dominant expectation remains centered on U.S. legalization. A favorable rescheduling decision from the DEA would be a monumental psychological and operational catalyst, likely triggering a massive rally across the entire sector. It would allow Tilray to formally recognize its U.S. assets and potentially list on a major U.S. exchange without the restrictions currently in place. But the reality is that the timeline for this remains uncertain, and the legislative process is fraught with potential roadblocks. Relying solely on this single catalyst is a high-risk strategy. The more immediate and perhaps more realistic catalysts lie in the company's operational execution. Can it continue to grow its beverage alcohol market share? Can it achieve profitability in its Canadian cannabis operations? Can it capitalize on the incremental expansion of the European medical market? These are the factors that will determine the company's fundamental health, independent of U.S. political whims. Do you think the government will pass legislation in favor of the cannabis industry anytime soon? Comment below with your honest prediction. The risks are equally pronounced. Further delays in U.S. reform could lead to profound investor fatigue, causing a sustained capital flight from the sector. Competition is also intensifying on all fronts, from other large licensed producers to smaller craft operators in both cannabis and alcohol. Any misstep in integrating its numerous acquisitions or a failure to control costs could further spook the market. In summary, the narrative of Tilray Brands is a classic case of expectation versus reality. The broader expectation is for a volatile cannabis stock whose destiny will be decided by a single legislative event in the United States. This view fuels the boom and bust cycles that define its chart. The deeper reality is that of a company attempting a complex and expensive transformation into a diversified consumer brands company using its beverage alcohol division as a strategic beachhead for future U.S. cannabis market entry. Today's sharp decline is a painful reminder that the market currently weighs the frustration of legislative delays more heavily than the progress of this underlying strategic pivot. For investors using any platform, from Fidelity Investments to Robinhood or Interactive Brokers, the key is to look past the smoke and mirrors of the daily price swings and analyze the structural foundation being built. The ultimate success or failure of Tilray will not be determined by a single vote in Congress, but by its ability to execute on its ambitious multi-pronged strategy to become a dominant force in the global consumer market for both cannabis and craft beverages. The tension between the short-term speculative frenzy and the long-term operational grind is what makes Tilray one of the most compelling and challenging stories on the market today.